Does raw human emotion dictate your financial decisions?
I like to shop.
I love shopping so much.
Or are we rational calculators of our own self-interest?
If you believe that, you can believe that pigs will fly.
It's a bitter scientific debate that has real-world consequences.
Let's talk about the speed with which we are watching this market deteriorate.
The crash of 2008 nearly collapses the global economy.
$1 trillion in mortgage investments have gone bad.
The crash really matters. It is unexplained by the discipline of economics.
That's just an insult, a pointless insult.
A set of amazing experiments reveals it was no surprise.
It was driven by psychology.
Experiments show our behavior is bizarre when it comes to money.
It's an almost irresistible force.
But not everyone agrees.
The observation that people feel emotions means nothing.
Stuff in the opening, I won't pay over that.
What happens when two powerful forces collide?
Emotion still drives the markets.
Mind over money. Right now on Nova. Now, the stock exchange is one small cog in a vast global machine that's the financial markets. Technology means trading can take place anywhere.
Trading up $2 on earnings. We got 50 tomorrow.
At night trading, one of the biggest private dealing floors in the world, traders buy and sell everything from stocks and currencies to commodities like oil and gold.
You know what? I had stuff in the opening. I won't pay over that.
$8 through the upside on 8. Sell.
And just as Adam Smith suggested, traders here compete fiercely to make as much money as possible for their clients and themselves.
You want to win, and it's the competitive nature of all of us that drives us to push harder and harder each day. You know, as the room gets busier and busier and the noise starts to elevate, if I'm sitting here and I'm not that active, and I see somebody next to me who's busier than I am, it gets me going.
That's Joe Hayward's total number he would.
Hey, Tommy, the 38,000 guy added 50, so.
Why does it matter what happens in places like this? Most of us use financial products like mortgages or mutual funds. The firms that sell us these products take our money and invest it to make more money in the financial markets. If traders make profits for these financial firms, they can then offer us cheaper mortgages and better mutual fund returns. The result, a matrix of money that connects us all. It's built on an economic model that says most of the time, most of us, and most of the traders behave rationally. But what if this model of human behavior isn't right?
Stocks shot higher, giving the Dow its best day
in 2005, rational economics, it seems, has delivered. Times are good and have been for years.
Real estate market in many parts of the country right now.
Many think the long boom will continue.
Earnings jumped almost 8-fold.
Our economic horizon is as bright as it's been in a long time.
For those in the housing business, these are gold rush days.
Economist Robert Shiller is unconvinced.
It did seem to me that there was complacency and overriding feeling of normalcy, that this can't be wrong.
He thinks the boom is a mirage.
Well, the real estate market has grown to new heights and new prices.
He's worried about one thing in particular: housing. Housing prices have gone up 6% a year for decades. In 2005, in some places, they're rising at 25%.
This was very anomalous performance. The idea that home prices always go up led people to think that they had all found the investment to end all investments.
Thousands came to a two-day expo hoping to learn how they could turn investments in real estate into personal riches.
Shiller believes America is in the grip of an irrational mania.
July was still the strongest housing sales month in history.
I predicted that it was likely to correct down and that it might cause a huge financial crisis and a worldwide recession.
In a book tour that summer, he warns of the dangers.
Economist Robert Shiller is out with a new book titled Irrational Exuberance.
It's kind of a frame of mind that we get into when prices keep going up and we see a lot of excitement. That's irrational exuberance.
Rational economists dismiss his warnings.
What does irrational exuberance mean? It's a lovely buzzword for a view that prices are higher than Bob Shiller thinks they ought to be.
Bob, who's a friend of mine, has been consistently pessimistic about prices.
The debate about whether rising house prices are the result of a mania or rational calculation intensifies.
Or the individual household was not being irrational. They were getting low down payments, low interest rates, so it was a rational decision to make, particularly when they expected prices to continue to rise over time.
Financial institutions share the conviction that house prices will continue to rise. They offer mortgage deals never seen before. And the country's top financial officials are optimistic.
The U.S. economy has weathered such episodes before without experiencing significant declines in the national average level of home prices.
House prices have risen by nearly 25% over the past 2 years. At a national level, these price increases largely reflect strong economic fundamentals.
This confidence isn't just a shared hunch. It's based on the widely accepted models of rational economics.
Basically, you'd build the models assuming people were like these calculators who would look at the range of possible outcomes and the risks and balance it all out.
In 2005, the economic models assumed consumers will make careful calculations about their mortgages.
Economists assume we shouldn't worry about people taking out 95% mortgages or 100% mortgages or trust me mortgages, because they'll only take out those mortgages if they have made all of the relevant calculations.
Instead, as housing prices soar, many consumers take out mortgages they cannot afford and assume debt based on the rising value of their homes. So why might so many people be willing to take on so much risk? At Stanford University, researchers stumble on a possible answer. Their research at first has nothing to do with money. It isn't even being conducted by economists. Psychologists are using powerful brain scanners to explore the mysteries of the human mind, especially emotion.
I started looking in the brain because I was interested in emotion, and I was convinced there must be something in there that could give us a handle on emotion.
Psychologist Brian Knutson wants to know how emotions affect one of the oldest parts of our brain that evolved so long ago we share it with many creatures, even lizards.
In general, the lower the area of the brain, the farther back it goes in evolution, right? So we humans still have these subcortical areas deep in the brain that are ancient.
This part of the brain is called the nucleus accumbens, and it gets triggered by the most primal human needs.
From the standpoint of survival, it makes a lot of sense that natural rewards like food and sex and so forth would activate this circuit that makes you go out and get those rewards.
This part of the brain plays a crucial role in drug addiction. Out of curiosity, Knutson tries to find things that excite it as much as the prospect of sex and drugs. So he asks people to imagine they are about to receive some money.
Once we started using money, we found very reliable activation in these emotional circuits. This suggests that it's not just sex, it's not just drugs, it's not just food that activates these circuits. Money also activates these circuits, and it does so very powerfully.
Could the fact that an ancient part of our brain gets excited by money explain some of the frenzied behavior by financial traders and consumers during the housing boom?
If markets are efficient, there's no real need for government because the market itself will make sure that prices are always equal to the right price.
Instead of regulation, rationalists believe the markets will come up with their own mechanisms for managing risk. And so they have. The first was invented here at the Chicago Mercantile Exchange, where traders handle vast sums of money all the time.
I'm an independent trader and I trade my own money, 50 contracts to 100 contracts at a time. That's basically a $50 million to $100 million contract size.
Traders here make their money by effectively offering to insure people against risk, including agricultural producers of pork bellies and oranges.
Long before this orange became an orange, the farmer had to grow it. Well, he doesn't know what will be the price of that orange when it comes to the market finally 10 months later. Will he make a profit?
As protection, farmers take out contracts to insure themselves against the price of oranges dropping.
Nowhere in the market are you going to see an orange passed from one trader to the next. And yet, oranges were transacted in an invisible market. That is a risk transfer mechanism.
When he was chairman of the exchange, Leo Melamed took that idea with oranges and applied it to financial assets in a contract that became known as a derivative.
It was a revolutionary idea. The board of directors looked at me as if I was half crazy. What do you mean? At the Chicago Mercantile Exchange, the Pork Belly Exchange? You've got to be crazy, Melamed. You're going to take this exchange and blow it up.
If you're worried that a financial asset like a currency might suddenly move down, you can buy a derivative that pays you if that happens.
Everyone in the world uses one or another form of financial derivatives to insure the risks that they have.
Derivatives are so useful they move beyond the mercantile exchange, and with less oversight take on complex new forms. There are even some created to insure the risks of issuing millions of home mortgages. But as all these different risks grow, someone has to measure them. At modern temples of finance, the atmosphere is less Chicago mercantile and more like academia. No wonder. The average trader here is likely to have a graduate degree in math.
The culture of trading has changed. When I started in this business, which wasn't that long ago, in 1992, there was a lot of screaming and yelling on the trading floors. People were throwing phones. Today, you go out on the trading floor and it's relatively quiet. There's a lot of tapping of computer keys, and it's a different type of person involved in trading.
These traders are called quants because they use equations and statistics to quantify their risks mathematically. Only then do they program their computers to make trades. The financial markets are now dominated by the highly mathematical approach of the quants, one that's been designed to ensure risks are assessed rationally and scientifically.
There are still aspects of trading that are an art and not a science. What's changed is that there are now a lot of aspects that are treated as a science, and that's new over the last 20 years.
At Chapman University in California, this cycle is studied by Vernon Smith.
A lot of economists do not like the idea of bubbles because they're so hard to understand.
In this experiment, Smith wants to see what happens when students compete to earn money on a simulated trading floor.
Participating in a trading experiment?
It's not a classroom setting. It's a setting in which your job is to make as much money as you possibly can.
Will be paid based on the dividends that you have earned, plus any
If they play the game well, they could earn hundreds of dollars.
This is real money, serious money.
Each of them has been given an imaginary financial asset to trade. And right from the start, they're told to be careful because the asset will decline in value over time. By the end of the game, it will be worth nothing.
The asset will live exactly 15 periods of trading.
And the question is whether this will determine the prices at which they exchange or whether the prices at which they trade deviate from that.
Okay, the experiment has begun.
On the screen, they see the prices the other traders are offering to sell or buy at. And they also see the value of the asset as it relentlessly declines. Shown here is a dashed black line heading downwards. As prices rise, they reach the actual value of the asset. And something strange happens. Everyone begins to take risks.
So you notice the price has been racing up.
In the hope of making profits, they now trade high above the real value.
There's quite a frenzy, way above fundamental value.
In the flurry of buying, the students are now ignoring the fact that the asset will soon be worthless.
We're in period 10, and at the end of period 15, these assets are worth nothing.
As the end approaches, the price remains way above the real value. The graph has taken on a classic bubble shape. And when the players try to get out, no one wants to buy. Instead of earning hundreds of dollars, the students watch the graph collapse, leaving them with next to nothing. This experiment suggests bubbles may be part of the fabric of financial markets.
We've done hundreds of them now, and with all kinds of different subjects. I went to Chicago and I recruited some over-the-counter securities traders, put them in an experiment. They gave us a magnificent bubble.
It's a bubble where prices go up and then suddenly plummet. How could such a simple pattern have brought us so close to economic catastrophe? In 2005, as housing prices grow, the mechanisms that rational economists count on to keep the markets safe become part of the problem. Major financial institutions issue billions of dollars worth of derivatives to protect mortgage lenders against home loan defaults.
And every time you created one, you could make 6% of the total value you created. This was like a gold mine.
These derivatives are traded and their price soars. And suddenly they have become the 21st century equivalent of tulip bulbs. Within a few years, $60 trillion is riding on them. All this is fine as long as the quants are calculating risk properly. But their mathematical model assumes the prices in markets are always correct.
It was assuming that house prices would keep going up. It was assuming that very few people would default on some very risky loans. It was essentially assuming that there was no more economic cycle.
Notice all those for sale signs out there on homes the owners just can't.
When home values fall, the model breaks down. The price of derivatives plunges, leaving financial institutions with billions of dollars of debt.
Investors face the news of another major financial collapse on Wall Street.
Banks couldn't sell these things at any price, so effectively, their price was nothing.
Years of a financial meltdown on Wall Street.
On the eve of the crash, there was a whole intellectual edifice built on the assumptions of rational decision making.
The only bank in the red right now, Bear Stearns dragging the rest.
It's really hard to say that the market is rational and perfect and knows what it's doing when it's clearly capable of freezing up and ceasing to function.
As fear grips the market, financial firms pull back their money.
There was blood on the floor at the end of trading on Wall
and refuse to lend to each other.
It has been a roller coaster.
Uncertainty leads to something that looks very much like panic.
You can give it the charged word panic if you like, but in my view, it's just a change in taste.
$1 trillion in mortgage investments have gone bad.
Emotions is how human beings make rational decisions. You know, when that lion is coming, it's important that you feel some adrenaline and some fear, and that's how you make the rational decision to run like heck in the opposite direction.
The Dow tumbled 240 points while the Nasdaq sank.
Even if you take this, we have another 30 years like we had in the past, including this recession. This would be a great achievement for the world.
Those of us who have looked to the self-interest of lending institutions are in a state of shocked disbelief.
We think we've got a good quantitative framework which takes care of all the risks, but it's missing something. It's a case where people believe the theory too much, and they were willing to make huge bets based on a theory that really wasn't right.